Could the most brutal liquidation event in crypto history be the prelude to an unprecedented market reversal? We just witnessed what can only be described as a historic flippity-flop, a cascade of sell-offs and liquidations so severe and so swift that it left the entire crypto space holding its breath. It was a financial storm, perhaps one of the fastest and most violent in the digital age, rivaling even the most dramatic margin calls of the traditional stock market. We're calling it Red Friday, a day that etched itself into the memory of every investor. Now, emerging from the wreckage, the single most important question is whether this catastrophic event was merely the chaotic setup for a massive retaliatory short squeeze. We're about to dive into the theories, the whispers, and the strange undercurrents of what truly happened. But before we explore the shadows, it's crucial to understand that chaos often conceals opportunity. For those who feel lost in the market's volatility, I've dedicated over a decade of my life to decoding these events. The result is the XRP Millionaire Blueprint. This is not just another simple PDF, it is a comprehensive guide born from more than 10 years of intensive research and hands-on investment experience. It lays out step by step the methods I use to identify the next seismic opportunities long before they hit the mainstream. If you are ready to move beyond reacting to the market and start anticipating its next move, the link is waiting for you in the description below. As we survey the current landscape, the numbers tell a story of a fragile recovery. XRP hovers around $237, with Bitcoin maintaining a position above $111,000 and Ethereum at $3,800. We're seeing minor gains across the board from Solana to Doge, but this is not the V-shaped recovery we've sometimes seen in the past. After previous major sell-offs, the market often snapped back with incredible force. This time is different. The sheer ferocity of the crash wiped out the very liquidity that would have fueled such a rapid rebound. The recovery, therefore, might be a much longer, more drawn-out process. Yet this slow grind could be the perfect environment for an unexpected twist, a moment where the shorts who bet against the market find themselves cornered and squeezed. Adding another layer of intrigue to this complex puzzle are the rumblings from the East. Just as the market began to teeter, whispers emerged that the Trump administration's latest announcements were not the true catalyst. Instead, all eyes turned to China, which appeared to be softening its aggressive stance on rare earth export controls. Official statements claimed the new policy was not a full export ban, and that applications meeting regulations would be approved, signaling a desire for global supply chain stability. Yet in the same breath, they issued stern warnings, stating they would stand firm against U.S. tariffs, declaring, "We do not want a tariff war, but we are not afraid of one." This doublespeak, a classic blend of diplomacy and threat, creates a deeply uncertain geopolitical climate. This kind of volatility is exactly what can trigger unexpected market moves. And with a high concentration of shorts, it could be the spark that ignites a massive squeeze. We'll need to watch the events of the coming days, particularly Monday and Tuesday, for clearer guidance as the market attempts to find its footing. The sell-off has paused, but the psychological damage is done. For a market to recover aggressively, it needs a surge of buying pressure. Historically, much of this pressure has come from leveraged positions. It's entirely possible that the immense profits made by short sellers could now be flipped, pouring back into the market as long positions and fueling the very recovery they bet against. However, we must acknowledge the hard lesson of this event. While it's easy to point fingers at exchanges for their technical failures, a significant part of the meltdown was a consequence of user risk. Leverage is a double-edged sword. It magnifies both gains and losses. We saw a similar scenario about a year ago during the Iran-Israel tensions, where a sudden massive wick liquidated even those with conservative 3x leverage. That event was a brutal teacher for many, including myself, fundamentally changing the approach to leverage trades. These moments are painful, but they are necessary for growth. The sheer chaos of the event was something to behold. Social media was flooded with images of XRP's price plummeting to an unbelievable 124 on some platforms, while SUI was seen hitting a shocking 56. On other major exchanges, the floor for Bitcoin was reported as low as $84,000. These were not true market values, but terrifying glitches in the system. phantom prices in a storm of failing infrastructure. In these moments of extreme volatility, the system itself broke. Exchanges froze under the weight of panicked users all trying to log on at once. More critically, the market makers, the essential entities that facilitate trades by providing liquidity, simply collapsed. There was no one left to buy the sell orders, creating a vacuum where prices went into freefall. Only a handful of exchanges with robust internal or third-party market makers managed to stay afloat. It was a stark reminder of a fundamental truth in this space. If you don't hold the keys, you don't truly own your crypto. Using centralized exchanges always carries this inherent risk. This leads us to a darker, more unsettling theory. Was this simply a market correction amplified by technical failures, or was it something more deliberate? One compelling perspective suggests the events of the last 48 hours were anything but coincidental. Think about the timing. The sell-off began moments after the US market closed on a Friday, a period when both Asia and Europe were largely offline. Then the oracles, the data feeds that supply prices to decentralized platforms, all began to mysteriously misfire, triggering a liquidation cascade. Simultaneously, market maker systems glitched, creating an efficiency vacuum. Major exchanges experienced user access issues preventing anyone from buying the dip. Even data sites like CoinGlass were reportedly hacked, leaving traders completely blind. When you line up all these coincidences, it paints the picture of a highly coordinated and well-executed attack. Could this be the work of a rogue state actor or a sophisticated hacking group? The possibility is chilling. Yet even as we entertain theories of a coordinated attack, there's another side to this story. An analyst named Benjamin Cowan had been calling for this exact scenario for weeks. He predicted Ethereum would fall to $3,600, that altcoins would bleed, and that Bitcoin dominance would surge. While his timing was off by about a week, his forecast was eerily accurate. He pointed out that this move precisely mirrored the market action of 2017, just before a major rally. Now, he still believes the base case is for Ethereum to rally to new all-time highs, a move that would undoubtedly fuel a massive surge across the entire altcoin market. So, we are left with a fascinating paradox. Was this a malicious planned attack? Or was it the violent but ultimately predictable market correction that a sharp analyst had already foreseen? Perhaps the truth lies somewhere in between, a convergence of factors where a calculated attack simply exploited the market's existing vulnerabilities to fulfill a prophecy. This was a weekend that shook the foundations of the market, and its effects will undoubtedly ripple through the crypto space for weeks, if not months to come. The dust is still settling, and the path forward remains shrouded in uncertainty. The map to navigating these chaotic waters and potentially securing your financial future is waiting for you. The strategies inside the XRP Millionaire Blueprint were designed for moments just like this, to find clarity in the chaos and to position yourself for the rebound that inevitably follows the storm. Don't let this opportunity pass you by. The link is in the description. Your journey toward financial sovereignty starts now. What we have witnessed is a powerful lesson in adversity and resilience. In any market, there are stories of terror and stories of triumph. The individuals who ultimately find success are not those who avoid losses, but those who learn from them, dust themselves off, and get back on the horse. Every experience, no matter how painful, is a learning opportunity. The question you must ask yourself is not whether the market will crash, but how you will respond when it